Welcome to Finance Foundations, your blueprint for building wealth.
Let's start with a puzzle. The S&P 500 is absolutely soaring, hitting all-time highs. But at the same exact time, how people feel about their finances, consumer sentiment, is near historic lows. We're talking levels we haven't seen since 2008. So how can both of these things be happening at once?
And this chart, wow, it says it all. For decades, these two lines, they basically moved together. Market up, people felt good, but now they have completely diverged, and it really suggests that the economy is kind of splitting in two.
So to figure this out, we need to pull back the curtain on what the stock market even is. So let's dive in and break down the three core parts of the market: the arenas, the scoreboards, and the trade itself.
Okay, first up, let's talk about the giant marketplaces where stocks are actually bought and sold.
The biggest of them all is the New York Stock Exchange, the NYSE. And just look at that number. That's its market capitalization, a mind-boggling $44.7 trillion.
Now, the two main arenas in the US are the NYSE and the NASDAQ. And you know what? They have very different personalities. The NYSE is the institution. It's the big board. Its roots trace all the way back to 1792, and it's traditionally been the home for the giants of American industry.
And then you've got the NASDAQ. It's the disruptor. It was the world's first all-electronic market, and it's the primary home for today's biggest tech companies.
Okay, so now we know the arenas. But how do we know who's winning? Well, that's where the scoreboards or indices come in.
A stock index is really just a measurement tool. It lets us track the overall performance of a specific slice of the market. It's basically a quick snapshot.
You've heard the names 1,000 times, right? The S&P 500 and the Dow Jones. But here's the thing, they measure the market in fundamentally different ways.
So the S&P 500 is really broad. It tracks 500 companies, while the Dow is this super select group of just 30. But the most crucial point, the thing you really got to know, is how they're weighted.
The S&P 500 is market cap weighted. That means the bigger the company, the more impact it has. The Dow, on the other hand, is price weighted, meaning stocks with higher prices have more influence no matter how big the company actually is.
And this quote just brilliantly illustrates the Dow's main critique. It means, for example, that a company with a smaller market cap but a super high stock price can have way more sway than a corporate giant like Apple. Kind of weird, right?
And because the S&P 500 is weighted by company size, just look at this. The 10 largest companies, just 10, make up nearly 40% of the entire index's value.
And speaking of the Dow, let's just take a quick look at how this all got built. It's the second oldest U.S. market index, which is really a testament to its long history as a market barometer.
So we have the arenas and the scoreboards. But what happens when you, the investor, actually make a move?
I mean, that click, it feels instant, doesn't it? But your order goes on this incredible, hidden journey through some seriously complex financial plumbing. See, your order doesn't just go straight to the NYSE. It's often sold by your broker to these massive wholesale firms in a pretty controversial practice called payment for order flow.
And this is all happening in a world that is completely dominated by high-frequency trading, where, you guessed it, speed is absolutely everything.
So the crucial thing to remember is this: the stock market isn't one single thing. It's a system of exchanges, indices, and a really complex web of modern trading mechanics.
Understanding this whole structure, well, that's the very first step. It's how you go from being a spectator to becoming a confident investor.
Thanks for watching Finance Foundations. And don't forget, we're your blueprint for building wealth.